I want to address a statement that I hear a lot from prospects, from listeners, and even advisors. And the statement is this: I don't want to make any changes until the market comes back. Now, if you think about it, the idea is kind of silly. Actually, it's ridiculous. However, everyone does it because it's human nature. Let me give you some examples. Let's say you go to a casino. Let's say you bring $1,000. Okay. Go to the casino, having a good time, and you turn that $1,000 into $10,000. Wow, you're having a great day. You're a rock star. You're a gambling magician. Now, after you turn that 1,000 into 10,000, obviously you keep playing because you think maybe I can keep going. Maybe I can turn it to 20,000. But at that point, your luck starts to turn. So instead of 10,000, you turn it back into 5,000. Now, at this point, you've got a choice. You can either A, say, hey, I won $4,000, and you can walk away with your winnings and come home and brag to all your friends on how you won $4,000. Option B is you keep gambling because I need to make it back. Now think about that for a moment. You turned $1,000 into 10, and then you lost 5 of that. So now you only made 4,000. So you want to make it back. Now I use this gambling casino example because what it's doing is it's showing you how silly the human mind is at times. Now, if you look at it logically, you made $4,000, you should be thrilled. However, that's not how our brains work. Your brains work looking at that $10,000 saying, I had $10,000. Now I only have 5. I lost 5. Well, it's not true. You made 4. But your brain thinks, hey, I lost 5. I need to make it back. So I'm going to keep playing until I make it back. Now, it could be that you get another run of great luck and you make it back. But then what happens? Once you make it back, are you going to keep going because you're on a good streak? Well, probably, right? Hey, you just made another $5,000 back, so you're going to keep going. When do you pull the plug? Are you going to pull it once you hit that 10? Probably not. If you're acting on your primal brain where you're trying to make it back, then most likely you're not going to stop at 10. You're going to keep going. Now, maybe you have more luck, maybe you don't, but statistically, you're going to lose your money. Just statistics. Obviously, you could make money, lose money, who knows? But statistically, the casino has the edge, which means you don't, which means you're going to lose. So the logical approach is when you're up, you should quit. That would be the logical approach. But most people don't do that because most people operate on their emotions. And emotions are dangerous when it comes to money. So let's continue down this logic path because emotions are going to drive you good or bad. They drove you to make that money in the first place, although you probably went to have fun. You probably didn't go to win. If you go to win, then this podcast probably isn't for you if the odds are stacked against you. Now, if you're playing poker, maybe you've got an edge. But if you're playing against the casino, you probably don't. So this podcast is for people who are smart. And now I know you're a pretty smart person because you're already listening to this. So let's talk about some smart stuff. Here's how your brain works. You have cognitive biases. Now, a cognitive bias is basically your brain operating in a way that leads you in a direction and will continue to lead you in that direction, whether it's the right path or the wrong path. Let me give you an example. When you're investing in the stock market, you naturally think that what you think about the stock matters. You don't care about the millions of other people investing. You care about what you think, and you think you're really smart. Now, this is normal. We all think we're smart. That's what we call an ego, right? We all have an ego. We think we're smart, right? And we are. However, a cognitive bias doesn't necessarily help you. So let me give you an example. Let's say you're investing in Acme Dynamite, using the Roadrunner as an example, right? You're investing in Acme Company, and Acme Company goes from $10 to $50. You think you're a genius. But did you cause it to go from 10 to 50? Or did millions of other people cause it to go from 10 to 50? Or was it because the company did a great job? Could have been many things, but we don't think that way. We think that, hey, I'm really smart because I picked Acme and it went from 10 to 50. I'm brilliant. I'm going to make lots of money now. However, the reality is that our current actions and our past actions and our future actions are not linked. So let me ask you this question. Let's say you invested in Acme, it goes from 10 to 50. Now you're looking at Acme now. Should you continue to invest in Acme? Well, it depends. Does your past action influence your present and your future actions? Yes, it does influence. Should it? Absolutely not. Let me give you a really simple example. You're flipping a coin, right? So you flip a coin. Let's say that the odds are 50-50 of heads or tails, just to clarify, because this is not a two-headed coin. So you have 50-50 chance of getting heads versus tails. So you flip a coin 10 times. It's heads every single time. Wow, you're on a streak of luck. You're making lots of money because it was heads 10 times out of 10. Well, what are the chances that the 11th flip is going to be heads? Now, most people would say, well, obviously it's a higher probability of being heads because it's been heads 10 times in a row. But the odds are still 50-50. Just because you had a run of luck that went 10 times in a row in heads, it doesn't mean that the next time is also going to be heads. The chances are still 50-50 that it's going to be heads the next time. But our brains are wired to recognize a pattern. And the pattern is heads all the way. So obviously going to keep going heads until I lose. Well, that's silly because we know the odds are 50-50. But our brains are wired to think otherwise. So using that example as an overlay for the investing example. So let's say you invested in, I don't know, Apple stock at a penny or $1. Let's call it $1. Or Facebook at $1. Google. It doesn't matter what company. Let's say you invested at $1. And now it's at a few $100s. You feel like you're a genius because you picked a great stock. Have all of your stocks been great? Probably not. But obviously in this one, you did a good job. Now, because this one stock you invested in went from $1 up to a few $100s, should you keep investing in it? Well, by that pattern, you could look at it and say, obviously I should stick with it. It made me lots of money. Let's let it ride. Well, I guess that sort of makes sense if the company's a good company and it's still growing and all this. But what if the company's overvalued? What if the company is making a change in their business model that's going to cause them to go bankrupt? What if? So the original Dow Jones companies, GE was the last one of the original Dow Jones companies. It means they're not still around. Now, those are some of the biggest, most successful companies in their time, but they're not around either through acquisition or bankruptcy or whatever it is. All companies go through cycles, good and bad. They don't go up to the moon forever. I think you can look back at history and know that all companies don't go up forever. Now, they might be around for a long time, but it doesn't always mean that they're the best investment. So I think you need to recognize that the past and the present and the future are three very separate things. Now, logically, I might make this statement and you'd deny it and say, you really think that the market cares about your portfolio? Now, logically, you say, no, I don't think that. But subconsciously, you do. You think that the market cares about your portfolio. The market doesn't care about your portfolio. The market doesn't care about you. It doesn't care about the millions of other people who are investing. The market doesn't care if you're up. The market doesn't care if you're down. The market doesn't care if you're flat with returns. The market doesn't care if you've been investing for a day or for 50 years. The market doesn't care because it's not about you. The market is much like life. And life is like a storm. And you're only a leaf blowing in the storm. The storm doesn't care about leaves. It just blows. As a leaf, you can't control the wind. You can't control the strength of the wind or the direction of the wind. All you can do is go along for the ride. With investing, you have choices. You can choose to invest or not invest. You can choose what to invest in. what percentage to invest in those things. You can choose to have a plan or not. Either way, the outcome is not determined by you. The outcome is determined by millions and millions of people who are also investing in the same things. You have no more control over the future than you have control over the past. All you really have control over is what you can do right now. So bring it back full circle. The idea of waiting until the market comes back is obviously pretty silly. And obviously everybody does it, but it doesn't make it right. Because if you're waiting for the market to come back, you're effectively hoping. As we all know, hope is not a strategy. Every single day you wake up, you should look at your portfolio and say, would I invest in this today? If the answer is yes, then keep it. If the answer is no, then you should make a change into things that you would invest in today. What happened in the past, what happens in the future have no relevance on what is happening today. Let's say your portfolio is down 20 or 30%. Let's call it 25%. Now, if the portfolio is down 25%, does that have any impact of what your portfolio is going to do this year or next year? Absolutely not. It has no relevance to what's going to happen in the future. So the idea of waiting until it comes back is a tad bit silly because it doesn't reflect what happened last year. Let me give you some real life examples on why this matters. First example, 2000 to 2013. If you started investing in 2000, you basically would have lost money for a total of 13 years. And the reason being is the market went down for the tech crash and it came back up. And then it went down again with the global financial crisis and then came back up. 13 years, you would have had a negative return in your portfolio if you put in a chunk in 2000 January. It would have been approximately July of 2013 before you even broke even. It was approximately 13 years. Now, if you look at that, you'd say, yeah, but eventually it came back. Yeah, but what did you lose? You lost 13 years of compounding. That is not insignificant. You can always make more money. You can't make more time. So the importance of looking at your portfolio today and saying, what is the thing I could do today that is going to be most effective, isn't waiting till it comes back. It is, given the criteria I see today, what can I do to have the best chance of success? Now you might say, yeah, but that was a weird time. Okay, I would agree. It was a weird time. You know what else is a weird time? The 70s. The 70s was also a very weird time where the markets went up and down. Basically, they went sideways for over 10 years. You might say, yeah, but that was decades ago. Things aren't the same. Okay, let's talk about a recent example. Japan. In 1990 till pretty much today, the stock market went down and has not reached the peak of 1990. The Japanese stock market peaked and went down basically for 23 years. Negative returns for 23 years and only recently started to come back and still has not eclipsed the peak. So do you really want to waste 30 years of compounding in your portfolio? Probably not. So if the market went down in the early 90s, you might have said, hey, let me just wait till it comes back. And the market kept going down. All right, well, I'm definitely going to wait till it comes back. And the market kept going down for 23 years. Now, if you were waiting till it come back, what does that mean? That basically means you were buy and hold or more or less afraid to make a change. And that's totally normal. I get that, right? We're all operated by fear and greed. But the reality is that if you're not compounding in a positive way, then you're really doing yourself a disservice. And what you're losing most is time. And time is the most valuable commodity that we have. Look, none of us want to make mistakes, and we certainly don't want to admit that we made mistakes. One of the most challenging things about investing is admitting that you're wrong. And the most successful investors have to do that every single day, buying and selling stocks, assuming that they're right or wrong. And the wisdom comes in knowing that you're not right or wrong, they're just numbers. and you're looking at this as a mathematical equation, you're looking at this as what's the best investment, it has nothing to do with your feelings. The more feelings you put into this equation, the less successful you're going to be. So, to wrap it up, I made this video because I think it's really important that people understand this concept. The markets in 2022 dropped significantly, somewhere between 15 and 30 some odd percent, depending on what you were invested in. And this includes stocks, bonds, everything. Everything went down. It was a very difficult year for most people, especially if you're diversified and you thought, hey, diversification is going to save me. Well, it doesn't always. And that was a good example. However, the reason I want to have this conversation with you today is to impress upon you the idea that waiting until it comes back is a very bad idea. Because that was only 1 year. What if it takes another 10, 20, 30 years for the market to come back? What are you going to do? Are you going to wait and waste 10, 20, or 30 years of compounding? Or are you going to make different decisions today that are going to give you a better opportunity for growth through that period? Now, if you look at the 70s, if you were just in equities, you basically would have been flat, you know, up, down. You basically would have lost over 10 years of time. However, there were some really smart decisions you could have made that would have made you a lot of money. Now, I'm not going to get into the 70s, but I use it as an example. And today, there are still a lot of places that you can make good money. And there will be some great opportunities to make money in the subsequent years, but only if you're prepared. Now, if you're still holding on to that company and you're hoping that it comes back, as we know, hope is not a strategy. If that's your approach, then you're going to lose out on these great opportunities because A, you don't know if it's going to come back. You don't know when it's going to come back, and you don't know if other things are going to have better opportunities. Now, we don't know that either. But what we do know is today is different from yesterday. And today, there are some good opportunities. And we do foresee there will be some great opportunities down the road, but only if you're prepared. If you're not prepared, you're going to miss out on potentially once in a lifetime opportunities that you're only going to have access to if you're prepared for those opportunities. Because think of it this way. If your stocks are down 20% and 2 years from now, the market goes down 50%, and you're all in the market, you've lost 50%. However, as an example, let's say you were in cash or treasuries or something that is not going to move all that much in value. And then the market goes down 50% and your investments don't. Not only did you not lose money, but in relation to the market, you actually made 100% return. Because let's take two examples, because I think this is really important to impress upon you. Example, person number one, we'll call him Steve. So all the Steves out there, I'm sorry I'm using you as this example, but I got to use the name. Steve is invested in the market. He has $100 in the market. Then the market drops 50%. Now he's only got $50 of value. Take person B. We'll call him Susie. Susie is all in cash. And I use cash because it's simple. Cash doesn't move in value. So Susie's got $100 as well. The market goes down 50%. Steve's down to 50. Susie's still at 100. So in comparison, Susie just made 100% return. Because before she could have bought, a share of stock as Steve did. Now Steve still has a share of stock, but it's worth $50. Now Susie's $100 can buy 2 shares of the same stock. So if you do the math, it's 100% rate of return by being in cash and missing that 50% drop. So this is an example of how being ready and prepared for crisis will give you great opportunities. Now, Steve has to wait till it comes back, because if he doesn't, he's going to lose all that money. But is that the case? Maybe the thing Steve's invested in keeps going down and the market goes up. We don't know. The point being is you can't get stuck in fear. If you're prepared, you will have great opportunities. If you're stuck in fear, you don't know what the outcome is going to be. You're going to be that leaf blowing in the storm. What would be better is if you're helping navigate that crisis with foresight, and understanding that being prepared is really important. We're Boy Scouts. We're always trying to be prepared. And no one's ever truly prepared for the future, but you do the best you can. And if you're prepared for opportunities, it will allow you to make outsized returns when other people are waiting for the market to come back. So I hope you take this bit of wisdom with a grain of salt and apply it to your life. Hopefully, this has been of value. Let me know if you have any questions.